Hey everyone, Lee Lowell here from smartoptionseller.com. How's everyone doing today? It is Saturday, January 14th, 2023. We're back for another edition of our free options trading YouTube videos. Typically what I do on Saturdays is I look at the charts, but this year I'm getting back into the options strategy videos. A lot of people email me, tell me they want some more option training videos instead of the usual looking at the charts, the Saturday chart videos. So I'm going to start doing some more of these option strategy sessions here. And the first one, of course, is going to be our bread and butter, how to sell put options and how to make money selling put options and why we sell put options and why we love selling put options so much. And on your screen here, what you'll see is the Smart Option Seller Guide to Selling Put Options. This is what we do. We are option traders. We are option sellers. At the Smart Option Seller, we're all about selling options, mainly put options and put option credit spreads. So today's session is going to be our method and what we do when we sell put options and how we sell put options and what kind of stocks we look at and all that good stuff. So I break it down in this PDF here. It's got basically 10 steps to look at. Very simple. So I'm going to show you, break it down, what we do. And so for those of you that know nothing about selling put options, or maybe some veterans that you've sold put options before we get into the strategy, I just want to make sure that everyone gets a copy of our free ebook, the Put Selling Basics ebook. Go to our website, smartoptionseller.com, click on the Put Selling Basics link right here, and you scroll down a little bit, and you put in your name and email address. We will send you an email that contains a link to get the free Put Selling Basics ebook, this thing right here. So get it, read it, it's free, and we love to hear from you what you think about it. So let's get back to our Smart Option Seller's Guide to Selling Put Options. Let's go from the beginning. What is selling put options and how can you make money from selling put options? For those of you that are just starting out, options come in two types, call options and put options. We pretty much settle on selling put options. Now you can be a buyer of options and a seller or a seller of options. We default to being sellers of options because we feel, or I feel over time, the 30 plus years that I've been in this business, that option selling gives you the highest probability for profit when you're making these types of trades. And why is that? Because when you sell an option, specifically what's called an out-of-the-money option, you have a lot of opportunities to be correct. Now, options all trade based on where the price of the underlying security is. In most cases, we're talking about stock options. So however the stock moves higher or lower or sideways, that'll determine your profitability on your options trade. And when you sell options, and I'm talking about selling the option as the initial transaction, it doesn't mean that you own the option first, then you sell it. I'm talking about selling an option first without ever owning it. And when you sell an option, you give yourself a lot of cushion to be right, because bottom line is wherever the stock ends up going is going to determine how profitable or not you are with your options transaction. So by selling an option, you get to choose this large range of stock prices where you can be profitable. On the flip side, if you're an option buyer, there's only one way for you to be correct. The stock has to move in a certain direction by a certain date because all options expire. So as an option buyer, the stock has to move and has to go to one place in order for you to be profitable. On the flip side, option selling gives you a nice big range to have profitable trades. So we like to sell put options because it also offers an opportunity to potentially buy a stock at a much cheaper price than where it currently trades. So some of you might know put options, the buyer of a put option has a different outlook than the seller of a put option. When you buy a put option contract, you're predicting that the stock price is going to fall. Now, if you're a seller of that put option contract, you're predicting that the stock is either going to stay flat or go higher, but the stock could actually fall a bit and you'd still walk away winner. But in this case, what we're talking about selling put options is there's two ways to look at selling put options. Number one, you're giving yourself an opportunity to buy a stock a lot cheaper than where it currently trades. So if a stock's currently here and you sell a put option with a strike price down here, what you're doing is you're saying, okay, I'm willing to step up and buy this stock at this price down here. So when you sell a put option contract, what you're essentially doing is that you're giving someone insurance on their stock position. So if the stock falls, you'll step up and buy that stock from them at that cheaper price. Okay, so you're entering into a contract to potentially buy a stock at a later date in the future at a cheaper price than where the stock trades now. So if there's a stock out there that's a little bit too high for you in price that you don't want to buy at its current price, and you say, you know what, I'd be willing to buy this stock if it falls a little bit cheaper. Well, you know, what you can do is instead of just waiting for the stock to fall and buy it when it falls, what you can do today while the stock is still high is that you can sell a put option at a level where you would be comfortable buying that stock or potentially buying that stock, and someone will pay you money for your obligation. Okay? It's like someone buying insurance on their stocks and they're paying you for that insurance. What kind of insurance are you offering them? The insurance is that you're willing to step up and buy the stock from them if it falls in price. Okay? And in exchange for your obligation and or selling them the insurance, they're going to pay you money. So how do you make money selling put options? Well, because you're selling insurance to somebody and they're going to pay you. And you could make a lot of money by selling this type of insurance and never have to buy the stock. You know, sometimes you may be able to get to buy the stock, sometimes you won't. But the second way to sell put options and make money is just the pure speculation that you don't think a stock is going to fall X amount of dollars by the expiration date, and you're just there to make the money and collect the money. Think about insurance companies, casinos. They're there to just take the person's bet, the buyer's bet, and most of the time those bets don't pay off, and the insurance companies and the casinos make all this money. So there are put option sellers out there that are just there to purely collect the income. And that's a great way to make money over time. We do that. That's how we do it in our newsletter. But the other thing, like I said, is that some people actually want to buy the stock if it falls in price. And then if they have to buy the stock, then they can hold it forever and the stock goes up and they get the price appreciation. So there's two ways to look at it. Number one, as I said, you're there to potentially buy the stock because you want to buy the stock. Number two is that you're just there to collect the income, collect the premium. So there's two ways to look at it. But the way we do it at the Smart Options Seller and in the newsletter that we run is that we choose very conservative strike prices. So if the stock's here, we're looking for strike prices way down here to give us a nice buffer. And so our goal really isn't to buy the shares of stock, but if we have to, we will, because the stocks that we choose are really quality stocks. So let's start going over the list here, and then I'll show you some examples of what we can do and how we do it. So if you're interested in learning how to make some money off of selling put options and or potentially buying a stock that you like at a cheaper price, let's go over that right now. So the first thing that you have to do is you pick a favorite stock that you'd be interested in buying. Whatever that stock is, however you come across that stock, you'd say, you know what, this stock is good. I want to buy some for the future, and I'm willing to step up and buy this stock, but I don't want to buy it at its current price. Okay, so like I said, if the stock is here and it's too expensive for you, what price level would you be comfortable potentially buying that stock? So number two, you have to pick your desired buying level. If the stock's at 100, would you be willing to buy it at 95, 90, 85, 80? You decide what your buy-in level would potentially be. Okay. Now then you check the charts, the stock charts, to see how that stock looks. Is the stock in an uptrend? Is it in a downtrend? Is it going sideways? You decide. For us in our newsletter, we typically like to focus on stocks that are either trading neutral to bullish, because that makes the trade work out faster. If the stock continues to go up, the trade will work out faster for us. So what does that mean? Well, if we sell a put option at one price, if the stock goes up, that put option value goes down, which is good for us as an option seller. You sell something at a high price, you want the price of it to go down so you could potentially buy it back at a cheaper price in the future. That's how we make our money in our newsletter. We sell the option at a high price, and then when we try to buy it back at a cheaper price and lock in the gains in between. In order to do that, the stock either has to stay flat or go up in price over time. So we want to typically choose stocks that are ready to go on an upswing. Okay, so you look at the charts here, number 3. Now, here's where we get into some of the technical factors. What strike price should you choose? If you're not sure what your buying level would want to be, how do we choose the strike price? When you trade options, you have to choose a strike price. Okay, so what we do is, and how we pick the strike prices, we always want to make sure we have a 20% buffer between the current price of the stock and then the strike price that we choose. So if the stock's at $100 a share, 20% buffer would be $20. So we'd be looking at the $80 strike. Okay, that's a 20% buffer. Now, why do we do that? Because you need to give the stock an opportunity to gyrate in price over time. Okay, stocks always fluctuate up and down. So you want to give yourself a decent cushion, a decent buffer to allow the stock to gyrate without getting knocked out of the trade early. And I found over time, a 20% buffer on high quality stocks is that would be a large drop for a lot of stocks in a short period of time. And I'm talking, 2 to 3 months out in time. All right, so we've gone over the first few steps here. You pick a stock that you like, you pick your potential buy-in level, you check the charts, you choose a strike price with a 20% downside buffer, and here's the last real technical part of it is that you want to choose the shortest expiration date where you can get at least 25-cent premium per contract on that option. Okay, so you have to go through the option chains, and I'll show you that in a second, and you want to choose the shortest expiration period where you can get 25 cents or higher on that option contract. Now, what does 25 cents mean? Well, when you're trading options, each option contract consists of 100 shares of stock. So you have to multiply 25 cents by 100 equals $25. So when you sell one single put option contract for 25 cents, you're actually getting $25 in your pocket. Okay? If you sell 4 of them, you're going to get $100 in your pocket. Now, what you have to remember is that when you sell put options to potentially buy the shares of the stock, you're actually putting yourself on the line to buy 100 shares of stock. For every one put option contract you sell, you're putting yourself on the hook to potentially buy 100 shares of stock. Okay? So you have to know, well, do I have enough money to buy 100 shares of stock if I have to eventually buy the shares of stock? So if you sold an 80 strike put option, 100 shares at $80 is $8,000 in the end if you have to follow through and buy the shares. So do you have $8,000 to buy the shares if it comes down to that? Because there's no guarantee that you'll have to buy the shares. The stock has to fall down to $80 by expiration in order for you to follow through and pay your $8,000. If the stock doesn't fall that far, you never have to buy the shares. So that's what some people like to do. They like to sell the put options hoping that the stock doesn't fall because they don't really want to buy the shares of stock. All right? So if you've sold, 4 of these put option contracts and, of the 80 strike and you get assigned, it's called getting assigned. If the stock falls down to 80, now you have to buy 400 shares at $80 each. That's $32,000 that you have to have free and available to buy your shares of stock. So you need to make sure that you're how many shares you're going to potentially buy, you're comfortable with, and you have the amount of money to pay for those shares if it comes down to it at expiration. Now, the way that we do it in our newsletter and the way a lot of people do it, they choose strike prices that are way out of the money, 20% or more cushion, and there's no way the stock's going to fall that far. Okay, they're just going to collect the $25 premium, and then at expiration, if the stock doesn't fall to the strike price, you walk away free and clear with your $25 or $100, depending on how many contracts you sell. All right. So then we want to check the probability. There's such a thing called a probability calculator that I'm going to show you that tells you what are the actual chances of the stock falling from $100 to $80 within the expiration period. And I'm just using 100 to 80 just as an example. I mean, it could be whatever stock price it's trading for, you can find out what the chances are that of happening. So it really comes down to the probability. What are the chances of the stock falling from point A to point B in the expiration period, and whether you're going to have to step up and buy the shares of stock, okay? And when you're ready to make the trade, You sell the option. It's called selling to open. You're opening a new transaction and you're selling it. That's the lingo is you're selling this contract as your opening or initial transaction, and you collect your cash. And that cash gets deposited into your trading account immediately. You click that sell button and the trade gets filled. Yet $25 minus whatever commissions you pay is going to end up in your account. And that's great. You now just made some money selling a put option, but the trade's not over. You're on the hook until expiration date, as you may or may not have to buy shares of stock. So yes, you've made the $25 or you've collected the $25, but you have to wait until expiration to see whether you're going to buy the shares or not. Now, in the end, if you do have to buy the shares, you still get to keep the $25, but you end up having to pay out to buy your 100 shares or however many shares you've sold put option contracts for. So you watch the trade until expiration, and at any time if you feel uncomfortable or you've locked in a lot of gain on the profit, you can close the trade at any time. Now, lastly, your defensive strategy is sometimes trades don't work out. If a stock's at 100 and you think $80 is a good buy, but all of a sudden the stock's trading down to $60 now, you're like, oh my gosh, I have to buy it at 80, but it's trading at 60. I've got a $20 per share loss locked in here, or an open loss. Haven't locked it in yet. What can you do? Are you locked into this trade forever? No, you can close a trade at any time. Sometimes you may have to close a trade for a loss. If you're not willing to buy the stock anymore, you can get out at any time you want. You just have to buy that option back. You buy to close. You buy the option back to close out the trade. It's called buy to close. Sell to open, buy to close. Now, your defensive strategy is, you can set a stop loss. If the stock falls, down to $70, you can say, what? I don't want to be in this trade anymore. I have to buy it at 80. It's trading at 70. I'm going to get out, just buy the option back and take my loss and move on. Or you can do what's called rolling out the trade, where you can, roll the trade into a future expiration date for a lower strike price. That's another video for another day, but that's something that you can do as part of your defensive strategy. All right. So let's go over an example here and figure out, how we can make some money and or potentially buy stock that we like in the future. So let's just go to our chart here. We're going to look at AMD, okay? AMD, Advanced Micro Devices. That's a stock that I have pulled up here. This is not a recommendation. This is just, I'm going to show you an example, walk you through it from A to Z on how to sell put option on AMD. So let's just assume that AMD is a stock that you like. Chip sector, you want to get involved in the chip sector stocks, and AMD is a quality company. And so you're checking the chart here. This is a daily chart of AMD, and it's been in this downtrend since January 1st, 2022, but you can see it's sort of moving a little sideways here. Maybe it's found a bottom here after all this time. After a full year of going down, AMD has bottomed out around $55 a share, you can see over here, and it's starting to move higher. And you think, what? I think AMD has bottomed, but I still want to cover myself. I don't want to buy it at its current $71 prices, where it closed $71 yesterday, Friday the 13th, January 13th, 2023. So AMD closed at $71, and you're thinking, I want to buy AMD, but I don't want to buy it at $71. I want to still, buy it at a cheaper price, give myself some cushion in case AMD starts to fall again. All right. So instead of just putting in, a limit buy order to buy the stock when it falls, there's no chance that AMD is ever going to fall again. You just don't know. What you can do instead is sell a put option. Now you have to decide, where's my comfort level? Where would I be okay buying AMD? I don't want to buy it at 71, but I want to buy it somewhere cheaper down here if I'm afforded that opportunity. So number one, you have to decide. But the way that we do it at the Smart Option Sellers, like I said, we always put in a 20% buffer between the current stock price and our potential strike price. So AMD is trading at $71. 20% buffer would be about, a little over $14 to the downside. That'd be around $56 or cheaper. So we'd be looking at a 56 strike price or lower, as long as we can get, 25 cents per contract or higher with the shortest expiration. Okay. So, $14 is 20% cushion. That would take us to about $56, which is right where that support level lies. Let's just say you want something, more buffer. You can look at the 50s, you can look at the 45 strike, the 40s. So now we know AMD is a stock. It's at $71. You're looking for a strike price 20% below that. What do? Well, you go to your option chain. Now, this is the option chain at Interactive Brokers that I use as a broker. You may use them as well. We go to the AMD option chain here. This is the option chain. You got calls on the left, puts on the right. Bid-ask prices, the only thing that you really need to key in on is to figure out how much someone's willing to pay you if you sell that put option. Okay, you don't need to look at the last column because these prices could be old, might have traded days or weeks ago. So always look at the bid-ask column to figure out what's the current price. All right, so we know that AMD's closed right around $71 a share, and we want to choose the shortest expiration date that we can get with at least 25-cent premium and at least 20% buffer. So what you can do is you start looking, manual labor here, you start looking at expiration dates, and you look at the strike price columns and the prices. So we could look at March, which is 62 days out in the future. And once you do that, you go down the strike price column. So we want to get a strike price at least $56 or under. That gives us at least 25-cent premium. So here's what you do. We're looking at March, 62 days out. You're starting at the 55 strike. Here it is, 93-cent bid at 95-cent offer. That means you could probably sell these things for 94 cents per contract. That'll give you $94 in your pocket. What does that do? When you sell that put option, well, now you're on the hook to potentially buy 100 shares of AMD at $55 per share. If AMD falls from $71, its current price, all the way down to $55 at the March 17th expiration date. So basically, you're going to be waiting for 62 days to see whether AMD falls from 71 down to 55. If it does, you will have to fulfill the obligation and buy 100 shares at $55 a share, and you have to pay out $5,500. And you may be happy with that, and you say, okay, I got a $16 discount from where AMD started at the beginning of the trade, and now I'm just going to hold my 100 shares to see if AMD will go back up in the future. Now, if you're not willing to step up at $55, you can look to sell the 50 puts, which you can sell for about 50 cents a contract, which would be $50 in your pocket. Now you have a $21 cushion from 71 current price of AMD all the way down to 50. $21 cushion. That's a pretty big cushion. Or you can go out down to the 45 puts, which would be the lowest that we would sell at this point, because we can get about 26 cents for those, $26 in our pocket at the 45 strike. That's a $26 cushion. Okay, let's go back to the chart here. 45 strike is down here. You have all this space right here. $45 is all the way down here. Can AMD fall from 71 all the way down to 45 in the next 60-something days? Well, we don't know, but we can check the probability calculator. And the other thing is that if you want to go even lower in strike prices, let's go out to April here. If you want to choose the 40 strike, let's see what that's paying. So 27 bid at 29, you always want to do something in between the bid ask. You can probably sell that thing for 28 cents a contract. That'd be $28 in your pocket. That would be a $31 cushion. Now, if AMD doesn't fall that far down to your strike price by expiration, the trade expires, it's over. You don't have to buy any shares, and you get to keep the money that you collected on day one. So think about, this is a way to make money over time. If you're choosing these way out of the money strikes, selling these things, and the stock never falls that far, you can just redo the trade over again for another 2 or 3 months out in time. And if the stock doesn't fall again in that period of time, you keep that money and you just keep doing the trade over and over again on multiple stocks. And then you can see how over time you're collecting all this cash, it's building up in your portfolio, and you never have to buy the stock. Now, as I said, if the stock does fall down to the strike price, then you have to step up and fulfill your obligation and buy the shares. But now you have 100 shares of a quality stock, and if it goes back up in price, well, now you have unlimited profit potential. Okay, so you have to look at it two ways. Are you there to just collect the cash, or are you there because you really want to buy the stock? You have to figure out what kind of mentality, what kind of trader you want to be. But let's get to the probability situation here. And let's go to our probability calculator. Now, like I said, probability calculator will give you an idea of what the chances are of the stock falling from point A to point B within the time allotted. Now, in this case, I put up the current price of AMD at $71. Our future date is 97 days in the future. Why is that? Because we're looking at these April options, 97 days in the future. We're looking at the 40 strike, okay? So let's go back to our probability calculator. We got 97 days in the future. Future volatility number is 50, and I'll show you where you get that. Our first target is 40. Our second target is 40. All we want to know is what are the chances of AMD falling from 71 down to 40 in the next 97 days. You click go, and you're going to see your chances in this box here and this box here. What this means is there's a 1.3% chance, only 1.3% chance that AMD will fall from 71 down to 40 in the next 97 days. That means you only have a 1.3% chance of having to buy the shares of that stock and shelling out the $4,000. Conversely, over here, there's a 98.7% chance that AMD will not fall down to $40. So there's a 98.7% chance that you won't have to buy the shares of stock at $40. Okay, so that's a pretty low probability of you having to step up and buy the shares. But in the meantime, you're still going to collect the $28 per contract. If you sell, 5 contracts, you're going to get $120, $130. But now you're on the hook to potentially buy 500 shares. Just remember how many shares you're playing with, okay? Now, you could, like I said, AMD is at 71. If you want to potentially buy it at $65, now you're going to get $400 potentially for that contract. $400, but you're on the hook to buy the shares at 65. So AMD, it's currently at 71. Could it fall down to 65 in the next 97 days? Yeah, there's a probability that it could because it's already been in that range. We choose the 40 strike all the way down here. AMD hasn't been, below 55 in a very long time, a couple of years at this point. So we're thinking $40 is a pretty safe bet that AMD is not going to fall. So we'll just collect the money, and then when that expires, we'll do the trade again, in the next 2 or 3 months. And we'll just keep rolling, keep making the money, keep selling the options, and, and hopefully that we don't have to buy the shares of stock. But that all depends on what you want, okay? So we go back to our calculator here. Where are we? Here's our calculator. There's this one level. These are the inputs up here, and these are the outputs. So all the inputs that are easy to figure out. You know where the price of the stock is. You know how many days are in the future. You know what your target is. But there's this one number right here, this future volatility. What is that number, and where do you get it? Future volatility, or volatility of a stock, basically tells you how erratic a stock has been over a period of time. Okay, what the 50 means, this is a percent. This means 50%. You don't have to put in the percentage sign, just put in the number 50. This tells you that AMD is predicted to fluctuate 50% higher or lower from its current price over the next year. Okay, and that's a pretty big range. So where do you get that? And that number is based on how AMD has fluctuated in the past. If you look at the stock, AMD has up, down, up, down, up, down. It's been moving down in price, but the probability doesn't care what the price is. It just cares about the activity. How erratic has it been? It's been moving up and down, up and down. Whereas a stock that's, very flat, that doesn't go higher or lower erratically, is going to have a much lower probability, like something like 20%. So where do we get this 50 number? Well, I'm going to pull up another website here that you can go to. This is the optionseducation.org website. You can see the address up here in the address bar, okay, optionseducation.org. And this is what's called this will give you some volatility numbers. Okay, this is a table here of of historical and implied volatility numbers. But the easiest way to figure it out is you click on this chart down here. This is the volatility chart. It'll open up a new window here. This is a volatility chart. Let me see if I could make this thing bigger, a little bit bigger. So this is a volatility chart, and you can see on the side, this is the percentage. This is where AMD's volatility currently is. Implied volatility and historical are a little bit different, but they typically tend to move in tandem with each other except for certain periods of time. Now, implied volatility is basically the option market maker's best guess about how AMD will fluctuate moving forward, okay? That's the orange or green line here, whatever color that is. The blue line is historical volatility, which tells us the actual moves that AMD has made in the past. So it's tracking the blue line is the actual moves. The orange line is what's projected the volatility to be. So right now, historical is somewhere in the low 40s and implied is somewhere in the low 50s. So somewhere in the middle, we can use as our number. We kind of take an average of the two. So I just put in 50%. Okay, 50% is where it's roughly now. We go back to the calculator here and we put in 50 right there. All right. So that's basically how you figure out the probability. Now, if you want a higher probability of having to buy the stock, then you pick a higher strike price. It all depends on what you want to do. Okay, we go back to the chart of AMD. It's at 71. Where are you comfortable potentially buying? $65, $60, $55, $50, $45, $40. You choose. You choose. If we go back to the option chain, we can go out a year in time from now to January 2024. Let's see what people are paying for these things and at what strike price. So the lowest strike price listed is the 25 strike. For a 1-year option, you can get about maybe 60 cents or $60 in your pocket for selling a 25 put. What does that do for you? Well, that obligates you to buy AMD at $25 a share anytime by next January. AMD's at 71 now. Is it going to fall down to 25 in the next year? Let's look at a monthly chart and see the last time AMD was at 25 bucks. Well, it hit $25 in 2019. So a couple of years ago, it was down at 25. But look, it went all the way up to over 160. So you decide what you want to do. And it doesn't have to be AMD. Like I said, this is just an example. Choose any stock you want. All right, so we go back to our, where's our list here? Let me move myself over. So once again, let's go through the list and we'll call it a day. Making money by selling put options. Choose a stock, choose a potential buying level, choose a strike price. The way that we do it, like I said, is we look for the 20% buffer and at least a 25-cent premium using the shortest expiration date. Now, you can tweak these steps. You can pick something with a 10% buffer or 5% buffer. If you want to get 50 cents or $1, just go through that option chain and look at the expirations and, look at the bid-ask comms, look at the strike price comms, and to decide how much money you want to get, what price are you willing to step up and potentially buy the shares of stock. So if your goal is to never buy the stock, make sure you choose a strike price with a lot of buffer. If your goal is to buy the stock, then you choose a strike price which is closer to the current price of the stock. It's totally up to you. Check the probability. All these things are at your disposal. All right, so that's our way, a Smart Option Seller's Guide to selling put options. If you go back to our website, you can click on our services tab right here, our Smart Option Seller newsletter. That is our newsletter that we sell. We pick the put options to sell. It's a paid newsletter, so you can take a look at that if you so desire. All right, so that is your guide to selling put options. I hope it's been helpful to you. I hope it gives you an idea of why we do it. It has a very high probability of profit. If you're choosing these strike prices with a big buffer, you're going to make the money, and there's very little chance the stock's going to fall that far. So that's why it has a very high probability of profit without you having to buy the shares of stock. But remember, you may have to buy the stock, so you got to make sure you have the money in your account to do it. All right, that's all for me today. Hope this has been helpful. Give me a thumbs up on this video. Don't forget to subscribe. Hit that red subscribe button. Leave me a comment. Please send me an email. I love hearing from you. I will always answer your emails. And I hope this strategy session has been good for you. I'm wishing everyone a good weekend and a good trading week ahead. This is Lee Lowell signing off.